Okay, now that we know what financial statements are required, it's time to look at how they should be structured. This chapter is all about the rules of presentation. We'll look at what needs to appear in each statement, how to classify things like assets and expenses, and where ias1 gives us flexibility and where it really doesn't. By the end of this chapter, you'll know how to turn a pile of accounting data into a clean IFRS compliant financial statement set. Here's what we're aiming for in this session. First, to understand how each financial statement must be structured under ias1. Second, to learn the required line items and classifications. You can't just list what you like and leave out the tricky bits. And finally, we'll learn how to apply these rules consistently and clearly so that users can understand, compare, and trust what they're seeing. Let's start with a statement of financial position, or more commonly, the balance sheet. IAS 154 to 59 tells us how this should be built. You need to present assets, liabilities, equity, and make it very clear which items are current and which are non-current. Also important, you need to include as minimum line items, unless they're clearly immaterial. The goal, a balance sheet that's clear, comparable, and gives users a proper snapshot of the financial position at period end. ias1 doesn't leave it up to you to decide what to include. It gives you a list of specific items that must be shown, if they're material. Things like property, plant and equipment, intangibles, financial instruments, inventories, cash and cash equivalents, trade payables, deferred taxes, share capital and reserves. The point is there are baseline expectations, okay? And you can't just lump everything into other, even if it feels easier. This is a core classification rule in ias1. You need to separate items into current and non-current. Current items are expected to be settled or realized within 12 months. Non-current items are everything else. This separation helps users understand short-term liquidity versus long-term stability. Some companies, like banks, may use a liquidity-based presentation, where items are ordered by how quickly they turn into cash, but that's the exception, not the rule. Now let's move to the income statement, or more formally, the SEGE statement of profit or loss and other comprehensive income. ias1 gives you a choice here. You can present everything in a single combined statement, or split it into two separate statements. One for profit or loss and one for OCI. Both formats are valid. The key is to be consistent and make it clear what's going where. No hiding income in the notes, no mixing profit with OCI. Keep it clean. IAS 1.82 outlines the essential components of the income statement. You must include revenue, finance costs, share of profit or loss from associates, tax expense, results from discontinued operations, and of course the final on profit or loss figure. Then for OCI, you split items into two groups, those that may be reclassified to profit or loss later, and those that will never be reclassified. This split is important because it helps users understand which gains or losses might affect future earnings. Now, for a classic reporting choice, how do you present your expenses? ias1 gives you two formats: function of expense, group by business activity, like cost of sales, admin, selling, nature of expense, group by what the expense is, like salaries, depreciation, raw materials. Both formats are allowed. You just have to pick one, stick with it, and explain your choice clearly in the notes. And please, no mixing formats mid-year. That's a guaranteed user confusion moment. This statement is like the company's equity diary. It tracks everything that changed during the year. It includes total comprehensive income, dividends, equity contributions and withdrawals, and adjustments from policy changes or error corrections. Each component of equity, like retained earnings or revaluation reserves, must be shown eyes separately. This is where investors look to see what happened to their share of the pie. Cash is king, right? The Biden statement of cash flows shows how cash actually moved through the business during the period. It's governed by ias7, but ias1 still requires you to include it. You split the cash flows into operating activities, investing activities, financing activities. This gives users insight into how the business funds itself, where it invests, and whether its operations are actually generating cash. Now let's talk about the notes, the unsung hero of financial reporting. They are not an afterthought. The notes must include 1. Significant accounting policies, 2. Disclosures required by other IFRS, 3. Any additional information. Needed to give a fair presentation, they should follow the structure of the financial statements and include cross-references, so users can navigate easily. Without good notes, the rest of the financial statements are just numbers with no story. Here's where ias1 lets you add some flexibility, but with strict boundaries. You can present subtotals or custom line items if they're made up of IFRS recognized figures, they're clearly labeled and consistently applied, and they're not more prominent than the official IFRS totals. So yes, you can show EBITDA, but you can't turn it into the star of the show, especially if it hides costs or misleads users. Transparency always comes first. Let's recap the main content and structure rules from this chapter. Your statement of financial position must include all required line items and clearly separate current from non-current items. The income statement and OCI must follow one of the approved formats and include all key line items. The balance statement of changes in equity shows all equity movements during the period. The cash flow statement, required via IAS7, gives insight into liquidity and cash generating power. And the notes bring it all together, disclosing policies, assumptions, and key details behind the numbers. Together, these rules give users a clear, structured view of the company, not just the figures, but the financial story. To wrap it all up, ias1 gives us a structured recipe for presenting financial statements. It tells us what statements we must include, which line items are mandatory, and how to maintain clarity, consistency, and comparability. Stick to the structure, follow the principles, and your financial statements won't just be correct, they'll be readable, reliable, and relevant. And that's what good financial reporting is all about.